Hi, everyone. I'm Mike Wilkerson, the founder of Stormwall Advisors, and this is our monthly update on the economy and markets for the month of November 2022. Want to jump right into this. I'm going to be using some slides and materials we've prepared for clients and others, some basic stuff on the macroeconomy, on the environment. So I'm going to share my screen right now and just jump into it. Bear with me one second. There we go. Okay, so hopefully you can see that. So I want to talk a little bit about October. Was an extraordinary month in the markets. I asked the question, was it the calm before the storm? We saw most all of the major stock market indexes were up substantially. I have argued in media and elsewhere that this is a sign of irrational exuberance, that something is not going right here. When bad news is good, when some of the fundamentals that we're seeing in the market, risk of recession, inflation pressures, downbeat expectations by CEOs and others, still the market continues to track upward, largely trading on technical flows, by the way, on options and derivatives, not on fundamental news. If bad news is good, good news is even better. And we see that the market was really banking on the expectations for a Fed pivot to change its course of rising interest rates. And of course, midterms coming up is also thrown into the mix. Despite all of that and the rally, I don't know that it's something we can count on. In spite of the expectations of the market, the same underlying risks remain. Persistent inflation, the war in Ukraine, the probability of recession increasing, and an energy crisis in Europe leading to a food crisis that seems to be spreading. We've talked about inflation. We'll come back to that in a little bit. U.S. diesel shortage is another big issue, as well as drought conditions in the U.S. that is impacting our food supply. And I would note, just given the inflation environment here in the U.S., it's also been the same in Europe. So we've had inflation in the U.S., CPI inflation above 8% for 7 months, which is the highest level in 40 years, over 40 years since 1981. This is really driven by energy. So you see some of the key items here out of the CPI, overall CPI 8.2 in September. But look at what's happening in fuel oils. So fuel oils is heating oil at home, particularly important to New England and the North in the cold of winter. Natural gas up by a third as well. And we see it across the board, double-digit increases in all of the things that people actually need to live on. So while nominal CPI not as bad, food, fuel, shelter, all that sort of stuff up pretty significantly. And we think we have it bad here. It's actually worse in Europe. So US CPI 8.2, I mentioned, in the Eurozone up 10.7%. Less bad in France, just 7%, but the largest economy, Germany, 11.6% inflation year over year, October. And the Netherlands up nearly 17%. So pretty severe. And again, energy is driving Europe's inflation, 42% increase in overall energy, which is feeding then into unprocessed food, processed food markets generally, and even industrial goods and services are up a bit. Here in the US, rising costs are leading to margin compression. So corporations, while they're getting increases in revenue, they're growing their top line by taking price increases. Volume's not growing that much. Consumers are trading down. For the companies themselves, their profit margins are being compressed as they have to fight a rising cost structure. This doesn't look like a good chart, helpful going into 2023. This is all stuff that's just come out in the past week for the third quarter for these companies. At the same time, consumers continue to lose purchasing power. So since 2020, lost 14% of buying power from the dollar. Since January of 2000, 43%. And by the way, if inflation continues at 8% for the next 2 years, it's actually going to get worse, meaning that the dollar will be worth half of what it was 24 years ago as a result of inflation. There's been a lot of talk about inflation coming down very quickly. The market has been saying, oh, no, this has got to end. Media has talked about it. The government has talked about it. Interesting, the analyst consensus on this chart shows what the inflation rate is expected to be coming down very, very quickly in a number of months after the start of the 8% plus inflation back in March. However, Deutsche Bank's analyst and strategist Jim Reed shows that once inflation hits 8%, this number here, it tends to persist for years, not months. So this is the median actual experience of inflation once it hits 8%. This cloud is the range, and this is what the market is implying. So I think this is unrealistic, and I think we need to strap ourselves in and brace ourselves for inflation to continue above 8% through 2023, if not longer. If you look at what's driving some of this energy prices, diesel up nearly 43% nationwide. We are in a shortage. The last report of the EIA, Energy Information Administration, says that we only have 25 days of supply left of diesel, and that it's going to hit its low point right before Thanksgiving. So that's pretty tough, especially in New England and Central Atlantic regions where it's up over 50%. And of course, diesel matters because diesel fuels everything. It's the trucks that deliver food, it's agricultural equipment, it's rail, it's shipping. Nothing in the industrial world is untouched by diesel. And while we feel it as consumers in the price of gas at the pump, typically, industry, food, everything else really is driven by these markets, which are now looking very unhealthy. Part of the reason that we're so short is not that we don't have the crude oil, it's that we don't have the refinery capacity. So this chart's very interesting. We're now at our lowest level. This was the beginning of 2022, by the way, of capacity at 17.9 million barrels a day. We haven't been in that position since 2014. Capacity grew during the Trump administration, right up until lockdowns, when with the shutdown of the economy, lockdowns, everything that went on, capacity was taken online and it was never brought back on. So that's what's led to us being in this difficult position today. At the same time, the Strategic Petroleum Reserve is now at the lowest level we've seen since 1984, as the Biden administration chose to deplete the reserve to bring fuels onto the market in an attempt to lower prices and to boost some political capital. This is at a dangerous level now, in that if there is a real emergency, not just trying to change prices, we're going to be short of what we may need if there's a supply constraint in the global markets. So I asked the question earlier, can we really trust the October rally, trust what was going on? If you look at what was happening in the first 9 months, all the indexes down pretty significantly, worst year on record in a very, very long time. The month of October got a breath of hope and optimism. All the markets up pretty significantly, bringing the year-to-date October numbers down or less bad than they were before. Still, the Dow Jones down 10%, NASDAQ down nearly a third as a result. I think that the market valuations still remain elevated. If you look at price to earnings today at 28.6%, that's still very high compared with a longer term average around 23 times, a very long term average of 16 times through booms and busts and other periods. If you look at this point here, nearly 44 times, this was in 2000, the height of the tech bubble, all the way down to the global financial crisis in 2008. And as we know, we've been in this everything bubble. Valuations went back up pretty significantly and now sit, in my view, again, compared with history, still too high given a rising rates environment and an environment in which recession looks increasingly likely. The market has been counting on the Federal Reserve bringing to an end its rate increase process. Yesterday, Federal Reserve Chairman Jerome Powell announced another 75% basis increase, bringing up the expected target interest rate to 3.8, nearly 4%, and the market implied terminal rate, in other words, the rate at which the market expects this all to end, went up as well as a result of that to over 5%. So the stock market's expectation or hope for a pivot, moving from tightening to pausing or even going down, seems to be off the table for now. Chairman Powell commented in his press conference afterwards that very bluntly said, pausing is not something we're thinking about. So took some of the air out of this hope and expectation. And again, if you look at underlying fundamentals, they're actually not looking great. Forward-looking indicators, as well as just static points in time, real average weekly earnings, personal disposable income, consumer confidence, Chicago PMI, expected labor growth, all out within the last week and all looking not great. There's a lot more information to come in the next week. We've got a big news cycle coming up with more economic information coming out. So just to wrap up, some observations, some conclusions. We are definitely not out of the woods yet. I think the bear market has more to run. High daily volatility, the big price swings that we're seeing is a warning sign. It's not a sign of a healthy market, but of a lot of technical trading, a lot of big bot trading, other things going on. Deteriorating economic conditions are increasing the probability, increasing the likelihood of recession going into 2023. And the markets are not really reflecting that right now. Clearly, geopolitics are playing an important role, and the most important sectors are going to continue to be the energy markets and food-related markets. We need to keep an eye on those. And midterms, whatever happens, we can expect some turbulence coming out of it with half the country unhappy. We've seen how in the past this can be a disruptive thing, an event. And so I would say, just in conclusion, that persistence is the watchword for the month. It's not the time for high-risk business or investment decisions that you don't have to make. If you want to learn more or get a copy of this report, email us here at hello@Stormwall Advisors. I'm going to stop the screen sharing for now and just say thank you for joining us. Hopefully you enjoyed this little download of information on the economy and on markets. Since we are on YouTube, I'd ask you if you would please to like it, to subscribe to the channel, to share it with friends and colleagues you think might get something out of it. I hope you did, and I hope that we get some good news to bring to you in December when we do this again in one month's time. Thank you for joining. Look forward to seeing you next time.